What's going on, everybody? It's your boy C-Zar, and we are talking about silver today. It's the 27th day of January, and here we are at about $109 per ounce of silver. 5 hours, 33 minutes left in this day, the 27th of January. Hit that like button, subscribe. Thank you all for being here, and let's get into it. The last video that I made on silver, I want to say it had to have been here. Had to have been on one of these days here. Not at the lows, we were at like the highs, but I was calling for the high to be right there. That's what the call was. I did say in that video that if I was wrong, if we pushed higher, there's still a chance, and I thought that the chance was greater that we'd come down, not that we'd go higher, but I did say there's a chance that we go to $110 to $120. The high came in basically right in that range as well. I did not call for this. I was wrong. I was expecting this to be the high. Nonetheless, this was a completely obvious zone to encounter and to find resistance. So even when I was proven wrong, the thought here, even though I haven't made videos, should have been, okay, we're going to go somewhere in this area logically. Why? Why would we go to that area? Well, if we look at this on a monthly time frame, we take our overall, would it be that high to low? Let's just see. Would it be this one? Maybe 6-month time frame. Yeah, I think that's it. We take this high to low here, and if you look, if you observe with your eyeballs, you can see that the golden ratio is right there at $122. Now, do we take this low? Is this a fake out low? Should it be taken? I don't know. Maybe we take this low. Either way, $110 right there, $122. So I said 120 because I forgot that it was 122, but whatever. It's the same area. Do you take it from this low, or do you take the fake out low? How I do analysis, I don't take the fake out low. How I do analysis, and this looks like a fake out to me. I don't take the fake out low. But with that being said, right, like this is the low of this move. This was a low of like a sideways move, and it was just a fake out. To me, it doesn't seem like you should count it, but it's far enough down that I think it might be worth it to count it to some degree. I mean, look, we're showing respect right at that golden ratio there. We're showing respect at this golden ratio too, and more respect, I would say. However you want to slice it, 110, 120, whatever, we're in that range where it makes sense to find resistance. Now, if you're of the belief that silver's just going to keep rallying up to 155, 180, $200, $300, it's going to hit $1,000, it can't be stopped. I mean, sure, in time, but I highly doubt that that time is right now. Now, my friends, is the time to consolidate. It's the time to pull back, and at this point in time, I would very strongly believe that we go down to $70. $70 is probably where we're going to find support. If we don't find support at $70 per ounce, you will see this thing retrace all the way back down to $50 to $40 per ounce, which would just be insane. I personally don't expect that silver will drop that much, but it can. It's possible. I mean, we did go from $50 all the way down to $14 an ounce, less than $14 an ounce, in a very short amount of time as well. We could definitely do that from here. Maybe not going this low, but just making that same kind of movement overall. I don't believe, personally, that after silver's been in this kind of, let's call it a range, this range of resistance, since the 1980s, I don't believe that here, within its first year of being above this range, that you're done right here. I don't think that you're done. I think you pull back, sure, you consolidate, whatever, but I do think you have more to go. I do believe silver has more to go, and really I think this quote-unquote generational move, this once-in-a-decade move, whatever, or maybe more than a decade move, however long it is, I think that it's a part of a process that started way back here in 1992. That this is a move that's just not finished yet, right? You had your first leg here, and then you're in the middle of your third leg, right? One leg up, second leg down, third leg up. Typically, your third leg, if you have an impulsive count, if you're counting waves moving up, if you go 1, 2, 3, 4, 5, typically you get waves of 5. The second leg and the fourth leg are the corrective phases. The second leg is the corrective phase. The fourth leg might be the corrective phase. The third leg and the fifth leg are typically the biggest. Typically the biggest, okay? And bigger than wave 1. If this was wave 1, from a low here to a high there, and maybe not 1992, maybe it was 2001 that this started. If this is wave 1, I would assume that wave 2 is probably, or wave 3, I'm sorry, will probably be larger than wave 1. I don't think that it stops here. It'll probably stop somewhere higher. We take a high here to a low down here, and your golden ratio is up at 243, I think that's where this next wave stops. But just like wave one, and each of these were on the 6-month time frame, so each one of these candles takes half a year to form. Just like this wave one, you did stop and kind of consolidate for a couple years before completing the wave. We're probably at a stopping point where we consolidate and then we continue going higher. I'm actually kind of curious, does this golden ratio line up with any other fib levels from the last really significant high to this low here? Yeah, the 2272. It's perfect. It's literally, wouldn't it be perfect? Hear me out. And maybe you wouldn't know this because you're not a fib nerd like I am, but this is for the Fibonacci retracement tool and the extensions on the retracement tool here. I've been doing this for over 10 years. This is my bread and butter to my analysis. Trust me when I tell you that this happens. Going from the golden ratio to the 1272, wouldn't it make sense to go from your 1272 to your 2272? And in fact, this procedure of going from the golden ratio to the 1272 to the 2272 is so common. I've seen it happen abundantly. If you've been following my channel, you've probably, even for like a couple months or maybe a year or since it began, you've probably seen this exact same thing play out multiple times on different charts, different assets. That 2272 lines up exactly with that golden ratio there as well. And just like this golden ratio, how you wicked a little bit above it, I would expect you wick above that. It's very common to wick above your 2272. You probably don't stop at 256. You probably don't stop at 240, but somewhere thereabouts, just a little bit higher. And I doubt that you cross 300. But that's where this move, quote unquote, is going to end. The only thing is, for this move to end, it doesn't have to be this month, next month. It doesn't even have to be 6 months from now. It could be 2 years from now. Just like it was here. You started consolidating really here. I guess you topped off here. It was January 2008 that you topped off. Well, I don't know if it was January, but that was the start of that 6-month candle. And then you didn't see higher prices than that for, that was 1 year. This is 2 years. You didn't see higher prices than that until 3 years later, right? You were all in the same move up, and you didn't see higher prices than this high for 3 years, all in that same move. We're on the 6-month time frame. It could be the same thing here, and that's exactly what I'm forecasting. So from a high to a low, expectation is golden ratio to the 1272. Because I personally don't think that you're going to pull all the way back down here. Maybe you do. That wouldn't be bad structure to pull back to $50 to $42. It wouldn't be bad structure at all, back testing prior significant resistance for support. It'd be very volatile. It can happen, but I doubt it. But it could happen. At the worst, we go down to $49 to $42, but I would at least expect $74 or somewhere thereabout. I'm kind of curious. Let me see here. From a high to a low, what did we get here? I mean, here you went above your golden ratio, a higher extension than what we got now, and you actually went down to your 886. Here you're ripping through, you're getting to your 2272 and stopping here. It's a little bit more extreme. Not really getting anything there. Monthly RSI is very, very overbought, my friends. You're at some of the highest levels that you've probably ever seen. I mean, literally, this is... We take away the weird stuff back here from like before things were actually traded more consistently. You're really at like your second highest levels in silver's history on the monthly RSI right now, and it's the 27th, so you're probably going to close somewhere around here. It's pretty high levels. You know, the last couple of times that we've been around here, let's just analyze what those moments look like, right? Granted, again, this one is the only one out of these 3 moments that's actually above where we are now. These other 2 are below, but still. Well, here, let's just look and see. We'll zoom way in. Looks like we got to. Here, you were at a relative high. This was on, and it looks weird. It is weird, but this was on in July in 1967. We didn't see higher prices than that until October 1967. Not quite 3 years, not quite multiple years, but still July to October. July, August, September, October. That was a quarter of a year before you actually saw higher prices. Could we consolidate here for a quarter of a year before seeing higher prices? Could we see higher prices by the end of this year? Absolutely. I want to actually correct myself, and I'm not correcting myself. I knew what I meant, but just correct in case anybody is confused on what I'm saying. I'm not saying that this high has to prevail for multiple years. I'm just saying we've seen that before. We could see it. Maybe this pullback, this consolidation takes 2 to 3 months. Maybe it takes 6 months, and then we move up. It doesn't have to take a year or 2 or 3. It can. Doesn't mean that it will. Okay. And that's actually a good moment right there to show that. But we still, it was 3 months, it was a quarter of a year before we saw higher prices. Here was the next one. It's pretty close. And from there, from that high, that was February 1974. Again, one could argue that this was all part of the same move, but you consolidated here. You didn't get above that high until 1979, 5 years later. I don't think it's going to be like that here. I don't think that it'll be 5 months later, but still, it's just illustrating the point here. Where we were in the RSI, we found resistance for 3 months. We found resistance for 5 years. And then here, when we found resistance, that was an ultimate sell-off that obviously we're not going to compare that. It's kind of an outlier as far as seeing a new high goes. But still, the point remaining, we found substantial resistance each time. We didn't even do the thing I meant to do. Let's just see. If we go here, from the high point, let's just delete all these. Right? So the high point there to the low point. Let me make sure I got it. Hold on. High to low here. You only dropped 9%. Okay? About 9%. Even less than 9%. If you were to drop about 9% from your high here, you've already done that. I doubt that this drop is over. Again, things were a little bit more screwy. I shouldn't say more screwy, but it wasn't the same level of interaction back here as it was once the 70s came about, right? Then we had more open trading hours for this, but still, nonetheless, it took 3 months for you to come back up from that. Even a 9% drop, it took you 3 months. From here, from a high to a low, we dropped more like 42%. This is more on par with what I would expect. And then from here, I'm not even going to measure that because you probably dropped over 90%, and I don't expect that to happen, right? That's an outlier. I mean, from here, maybe this is all we get. You pumped this much, and that's all you get is a 7% pullback, a 9% pullback. I doubt it. A 40% pullback might even be a little bit extreme if we're being honest. But something that pulls you back to around like $75, 36% or so, I could really see that happening. I could very much see that happening. And again, from a high point here to a low point there, golden ratio, or sorry, not the fake out low, the actual low, right? The actual low of the move down. Golden ratio down to your 1272, that'd be about a 40% drop. I mean, that makes sense to me. And then we pump from there, and then we continue to grow. If we take, let's see, we take this low here, because now it's not a fake out low, now it's the low to the high of this move, right? That's also right there around your 236, which is a perfect area to find support. What about from this low? A little bit below the 236. I think that's probably a better low to measure from. I mean, it makes sense. There's a lot of reasons to find support here. And then I just wonder if we look at the daily time frame. Look at that. Look at that. Also, a lot of price action that suggests we could find support here because we found support there as well. So it just makes sense to me. That's what we're probably going to do. That's the call. I don't expect this to take a short amount of time. I do expect this to take a long amount of time. It took us from this point, December 23rd, until January 26th, a month. It took us a month to go from this point where I think we're going to pull back to now. It took us a month to get up here. I'm going to think it takes twice, if not 3 times as long as that to pull back, if not longer. So on the bright side, this consolidation probably doesn't last for several years. Probably. Hopefully. It probably doesn't even last a year. But I would at least suspect that it lasts about a quarter of a year, which means it's January now, so it'll be Q2 before you start to recover. It might even be Q3 or Q4 before you actually get above these highs again, right? And that makes sense. End of year rally, going into the end of the year that we would rally. And then that, wherever we rally to, that will be the end of this overall wave 3. Hit that like button, subscribe. Thank you all for being here. I'll see you on the next one. Take care of yourselves. Bye-bye.